I've spent since 2013 building a UK-wide home buying company, nationwide estate agency, and my own personal property portfolio. So not only does that give me the inside scoop and access to information in the world of property investing you probably don't have, but it's allowed me to figure out the best way to retire with property investing that I'm going to be sharing with you in this video. Property investing, like any wealth building sector, is notoriously guilty of making it seem easier than it is to get rich out of. The truth is, property investing can hold the keys to your success or misery depending how you go about it. I've broken this video into 3 key sections you can skip between if you wish. They are 1, the basics of property investing, 2, the risks to watch out for, and 3, the key is to diversify. Section 1, the basics of property investing. When you're building a property portfolio, you are building a long-term business and you have to approach it with that mindset. If you don't want to build a business and you want to invest in something truly passive, then you are far better suited to investing in something like index funds rather than property. However, there are 5 incredible advantages to investing in property outside of other assets like bonds, stocks, and commodities, if you're prepared to build a business in it long term. They are 1, it goes up in value long term. Now, I appreciate there are points in time it's gone down in value, especially relative to inflation. But in general, over 5 and certainly 10-year blocks, it's only ever gone up in general. 2, it produces immediate cash flow through rent. You can typically get anywhere from 5 to 10% yields on property, which when you compare to stocks and shares that might produce you 1.5 to 2% a year, if you invested in something like the S&P 500 index, for instance, it's a big difference in immediate cash flow you can spend or reinvest. 3, you can insure it, so very difficult to lose your money. If you're unlucky, for instance, and a building burns down, it's insured. If a business fails, you've lost all your money in the shares that you owned. 4, it's easy to borrow money against to further invest. Buy-to-let mortgages are really easy to get, as the mortgage requirements are mostly weighted against the property and the income the property produces, not you and your income. And finally, 5, you can add value to it by upgrading, extending, or developing. This is the cherry on the cake. You can add value to property, which is really the secret to accelerating your property building, your wealth building and property investing in general. But like with any investment, these advantages are not going to apply to every property investment in the UK or across the world. Like if you invest in companies, some companies will perform better than others. It is no different with property. Generally, for every person I find that thinks the buy-to-let property investment market is dead, I can find a dozen that are thriving with it. And the difference between those people comes to not understanding the basics. The key strategy to succeeding in property investing is the BRRRR method, which stands for buy, refurbish, rent, refinance, and repeat. So in an ideal world, you want to buy a property that needs renovation. So let me take you through an example of one of my properties to illustrate this. And there is no reason why you can't do the exact same thing I've done for yourself. So I bought this property for £128,000, so I secured it below market value. I then refurbished the property into a 5-bed HMO, house of multiple occupancy. It cost me £121,000 to transform the property to this. So in total, the property cost me £254,000, including legal fees, stamp duty, and so on. So you can see using the same graphic that step 1, I purchased the property. Step 2, I refurbished the property, taking my total invested to £245,000. Now this is where it starts to get interesting. I then, of course, rented the rooms that generates £3,000 per month. After I deduct things like bills, cleaning, and so on, it leaves me with about £2,500 per month profit. I then got the property revalued at £450,000 and got a 75% buy-to-let mortgage that released £337,000. The mortgage cost me £1,100 per month, so that dropped my profit to £1,400 per month, which is still pretty great. But better yet, I have my entire £245,000 I spent to buy and refurb the property back, as well as the additional £92,000 on top. So I own this property, it makes me £1,400 a month after costs, and I now have £337,500 to repeat the whole process again. How many times would you need to do this to retire, do you think? Comment below. You can simplify this process if you want a more hands-off approach to investing, and there is nothing wrong with that. So as you can see, I could have instead chosen not to refurbish the property. I could have just rented it for £750 a month. The mortgage would have cost me probably £340 a month. So it would leave me with about £410 per month profit, which is still pretty good. And from the £121,000 purchase price, I'd have about £91,000 in my pocket to reinvest. So the money I have left to invest shrinks from the initial 121k to the 91k. So I either have to wait to add money to that to repeat the process, which could come from my rental profits or other income, or I could wait for the property to increase in value over the years and refinance the property when it's worth 20, 30% more in 5 years' time, for instance. This is still a really good way to go about property investing. It just takes longer, as you can plainly see. Section 2, so what are the risks to watch out for? Before I get into this section, I'd personally really appreciate it if you would subscribe to the channel if you want to watch more content like this, or at the very least like this video. It really keeps me motivated to keep making these for you. Anyway, let's get back into it. There are 2 key risks to property investing, and those are the effects on your time. Property investing is not 100% passive. And cash flow, making sure your investments are highly profitable. And they do interconnect to one another, because an overlooked fundamental in property investing is success is measured with the following equation in my mind. Positive cash flow divided by the time invested. How much profit is property able to generate you divided by the time you're investing to achieve it? I hear too many people just talk about cash flow being king when it comes to property investing. And so ultimately the trap investors then fall into is they invest in property that is high cash flow, but takes up proportionally far more time to manage. You need to focus on high yielding, high cash flow properties, but it can be so easy to wander into buying property investments that are super high yielding, but then suck up a lot of time and money to manage. So I'll run through some classic examples of this, but to be clear, these things aren't necessarily bad strategies. What is bad is when investors don't factor in the immense increase in time they take and deduct that time from the profitability of doing it. They are 1, investing in HMOs, so house of multiple occupancy. So yes, it increases cash flow. The example I gave earlier is an HMO, so I invest in them. But it does suck up more time managing, say, 5 tenants in a house rather than 1 tenant renting a house. Also, you have higher costs. Usually you have to include bills, internet, and sometimes cleaning, further decreasing your profits. If you factor these costs in, it isn't a problem. But if you look at headline yields, you may find that when you deduct the costs, the yield is nowhere near what you expect after costs. 2, buying low cost property that yield high. So yes, buying a £50,000 home and renting it for £500 a month is a fantastic 12% yield, but it takes as much time to manage 1 tenant paying £500 as it would to manage a tenant paying £2,000 a month. Time invested per pound is higher, and that needs to be factored in on lower value properties. And 3, investing in serviced accommodation. It's very time intensive managing guests. They have high expectations and often expect to have problems resolved quickly. Costs increase, managing cleans between guests and things like that. And you obviously have to factor in void periods and the stress of hoping each guest leaves you a positive review. I actually turned that HMO I went through earlier into serviced accommodation for about 6 months, renting the rooms out on Airbnb and booking.com. And even though I have my team here manage it for me, it was a complete pain. Yes, the revenue increased, but the management significantly increased. And we ended up turning it back into an HMO. And after costs, I'm making about the same money. So that isn't to say service accommodation is bad. I have property that performs really well as serviced accommodation. But you really need to consider how the time element to managing high yielding property investment types has on the actual profit of what you're doing. The final risk is, of course, cash flow, or more specifically, generating negative cash flow. So in effect, your properties are costing you more than they're making you. The way to avoid this is much of what we've been talking about, focusing on properties that generate healthy profits, so that if interest rates increase, you're finding your property's profits are decreasing, not that your profits have completely disappeared altogether. And importantly, by being disciplined with the amount of debt you take on. In an ideal world, none of us would want any debt, but in reality, I aim to not go beyond 75% loan to value mortgages at first, with the aim over time to pay those mortgages down to 50% long term, basically to make my property investments ultra low risk. And finally, section 3, the key is to diversify. Diversifying in property is actually quite difficult for most investors. On one hand, you want to build knowledge around a certain area, and when you've found a patch that works really well for you, double down on it. On the other hand, you don't want to put all your eggs in one basket. I'd recommend you, 1, try and expand your comfort zone little by little. At first, you may want to invest in an area you may have already lived before, but I'd recommend over time you aim to build your comfort to even different towns or cities. You learn of better areas to invest over time. 2, diversify the type of property you buy. Because at first it can be tempting to focus on just developing HMOs or serviced accommodations simply because they cash flow far better. But aim to build a portfolio of different property types that way you'll learn the pros and cons of each, but more importantly, you insulate yourself if, for instance, the rules change around serviced accommodation or HMOs in the future. And finally, 3, don't just invest in property. Although I've built my main businesses in the property sector, I diversify my investments into not just property, as we've been talking about, but in index funds, bonds, and a very small portion in high risk stuff like crypto. I love property and I think it's an incredibly safe investment, but I don't want all my knowledge to be built around just property. I'll see you in the next video up here.